from holding cash or bonds. But when the market is focused on policy risk, and they can still choose to hold bullion for its perceived role as a store of value and a source of liquidity in stressed conditions. Barron's reported a session with a weaker US dollar alongside higher US Treasury yields. That combination has been described in markets as a kind of sell America trade. It means investors are, at least for now, less comfortable holding US assets across the board, rather than simply rotating from shares into bonds. It's a subtle but important distinction. In a classic risk-off move, you might see stocks down, bonds up, yields down, and the dollar up. Today's mix was different, and that difference helps explain why metals had such a strong tailwind. Let's break that down. A weaker dollar tends to support metals priced in dollars because it can make those metals cheaper for buyers using other currencies. That's a mechanical effect. It doesn't guarantee a rally, but it removes one common headwind. It can also matter for sentiment because a falling dollar can be read as a sign that investors are looking for alternatives, and gold is often one of the first alternatives people think of. Higher Treasury yields, on the other hand, often act as a headwind for gold and silver. The reason is simple. Bullion doesn't pay interest, so when yields rise, the opportunity cost of holding metals can rise too. Investors deciding between a bar of gold and a government bond will often pay close attention to that trade-off. If the bond yield is rising, the bond looks more attractive on income alone. That's why the combination of higher yields and higher gold can look odd at first glance. But today, that usual relationship didn't dominate. Instead, the political and policy uncertainty appears to have outweighed the rate headwind. In other words, investors were willing to hold non-yielding assets because they were prioritizing perceived safety and liquidity over income. In stressed markets, the question often shifts from what earns the most to what can I hold with the least regret if the headlines get worse. Gold and sometimes silver can benefit from that shift. Barron's also noted the scale of the bond move. The 10-year US Treasury yield was reported around 4.291%, the highest level in roughly 5 months, and the 30-year yield near 4.934%. Trading Economics also described the 10-year yield moving above 4.25%, linking the move to the same Washington and Europe tensions. The key point is that yields were rising by basis points, not drifting by a vague amount, and that rise happened at the same time as metals were rallying. That tells you the market wasn't trading a single, simple narrative. It was trading multiple concerns at once, and the political shock was the one that dominated metals. If you're wondering why yields can rise during a risk-off session, it can happen for several reasons. Investors may be demanding a higher return to hold longer-dated debt when uncertainty rises, or they may be repositioning across assets in a way that pushes yields up, even as they buy other safe havens like gold. Another possibility is that investors are worried about the policy mix, including trade policy and what it could mean for inflation and borrowing needs, and they demand more yield as compensation. The key point for today is that metals didn't wait for yields to fall. They moved on the geopolitical shock. And once a move like that starts, it can draw in additional buying from traders who don't want to be left behind. Back to gold. The metal pushed into fresh record territory, with reporting citing levels around $4,728 an ounce during the latest surge. That's a striking level, but the driver is familiar. When the market is trying to price political risk, gold is often the first port of call. It's widely held, it's globally traded, and it's one of the few assets that doesn't depend on a promise from a government or a company to pay you back. That doesn't mean it's risk-free, but it does mean it can feel like a neutral asset when politics is the problem. There's also a longer backdrop that helps explain why dips, when they happen, have tended to attract buyers over the past year. When a market has spent a long time trading higher, investors can start to treat pullbacks as opportunities rather than warnings. That can create a pattern where weakness is met with demand, which in turn can make rallies feel more persistent than people expect. The London Bullion Market Association has highlighted just how strong the prior year's pricing regime was. It reported the average LBMA gold price for the year 2025 at $3,431.54 an ounce, compared with $2,386.20 in the year before that. That's a large step up in the average level, and it matters because it can change how investors think about what's normal. If the average price has moved up that much, then a price that once looked extreme can start to look like the new range, and that can influence how quickly buyers step in when the market wobbles. Alongside that, the World Gold Council has continued to describe central bank buying as a structural theme. Central banks don't trade like hedge funds. They tend to move slowly and they tend to think in years. When official sector demand is steady, it can underpin confidence in the market during periods of stress, even if it isn't the only driver on the day. It can also shape expectations. If investors believe central banks are likely to keep buying over time, they may be less willing to sell aggressively on short-term dips because they assume there's a long-term bid in the background. Now to silver, which has really been the headline move. The metal surged to new all-time highs, with reports citing prices just above the mid-90 US an ounce area. One report put a record at $94.73 an ounce, and another described futures trading above 95. Even by silver's standards, that's a dramatic burst of momentum. And because silver is smaller and can be more thinly traded than gold, it can sometimes feel like it's moving in jumps rather than in steps. The scale of the move has been eye-catching, and it's not just a gold story repeated in a smaller metal. Silver has its own mechanics. It can trade like a precious metal when fear is high, but it can also trade like an industrial metal when the market is focused on manufacturing and technology demand. That dual identity can make it more volatile because different groups of buyers and sellers can show up for different reasons, and sometimes they all show up at once. The Financial Times described a retail-driven stampede and highlighted tight supply and inventory constraints, including in London. It also pointed to the fact that silver supply can be inelastic. That means it can't quickly respond to higher prices because a lot of silver is produced as a byproduct of mining other metals. If you can't rapidly increase output and demand surges at the same time, prices can jump sharply. In practical terms, you can't just decide to mine more silver next week because the price is higher today. If silver is coming out of the ground alongside other metals, the supply response depends on decisions made for those other metals too. Investopedia also pointed to investor demand and exchange-traded fund inflows. An ETF is a product that trades on a stock exchange but holds assets like bullion behind the scenes. When money flows into a physically backed silver fund, it can translate into more metal being taken out of the market and stored, which can tighten availability further. That matters because it can turn financial demand into physical demand. It's not just people trading paper contracts with each other. It means real bars are being sourced, moved, and held, and that can make the market feel tighter. PV Magazine International reported the record silver print near $94.73 an ounce, attributing the move to geopolitical uncertainty, with commentary from Metals Focus. That lines up with the broader theme of the day, policy risk and geopolitical tension pushing investors towards hard assets, with silver reacting in an outsized way. Put all of that together and you get what some investors call squeeze-like behavior. A squeeze is when buyers rush in and sellers struggle to find enough supply at current prices. That can force prices higher quickly. It can also increase intraday swings because liquidity can thin out when everyone tries to do the same thing at once. If you're a buyer and you feel you might not be able to get the metal later, you may pay up now. If you're a seller and you see the price running away, you may step back and wait, which reduces supply even more. That feedback loop can be powerful and it can last longer than people expect. It's also worth noting that silver sits at the intersection of finance and industry. It's used in electronics and in solar supply chains, amongst other applications. That doesn't mean industrial demand is the driver of today's spike. It simply means silver can attract different kinds of buyers, and that can add to volatility when sentiment shifts. In calm markets, those different buyer groups can balance each other out. In stress markets, they can pile in on the same side, and that's when you see the kind of sharp move that we've had. Now platinum, the metal rose alongside the broader complex. It didn't lead the move, but it participated in the risk premium that swept across hard assets. In sessions like this, platinum can be pulled higher by association as investors treat precious metals as a basket, even though platinum has a larger industrial component than gold. When investors buy a basket, they don't always discriminate carefully between the different fundamentals of each metal in the moment. They may simply want exposure to the theme of hard assets, and platinum can benefit from that. The LBMA's annual averages also show that